Welcome everyone to the Tradie Toolbox Building Your Financial Success webinar. My name is Sky Diamond and I'm a member of the Customer and Stakeholder Engagement team and I'll be your MC. Firstly, I would like to deliver an acknowledgement of country. The QBCC acknowledges the Aboriginal and Torres Strait Islander traditional custodians of country throughout Australia and recognise the continuing connection to lands, water and communities. We pay our respect to Aboriginal and Torres Strait Islander cultures and to elders past and present. At the end of the webinar, you'll get a survey. It only takes a couple of minutes and it really helps us plan events for you that are relevant. If you're using a mobile device and the sound is low, check your device settings. Send any questions through via the chat box on the right-hand side of the screen, like you can see in the image. Keep in mind the information given during presentations is of a general and educative nature only and does not amount to legal, financial or specialist advice and should not be relied upon for the purpose of making business or other decisions. If we don't get to your question, we'll send your questions through to the appropriate business unit for a response. You can find all the information provided in this webinar and more in the PDF handouts, which you can access from your dashboard, once again, as you can see in the image. Our first presentation, called Building Your Financial Success, will be delivered by Natasha Dennis-Weller, who has worked for QBCC for many years as an integral member of our financial compliance branch. The second presentation will be presented by Louise Kuzovich from the Department of Employment, Small Business and Training, or DESBIT as they are known, who recognise the important relationship between employment outcomes, strong small businesses and a skilled workforce to the well-being of Queenslanders and their communities. I would like to welcome our first speaker, Natasha Dennis-Weller.
Thanks, Sky. Thanks for that great introduction. As Sky mentioned, my name is Natasha Dennis-Weller. I've worked for the Queensland Building and Construction Commission for quite a number of years now. The reason that we're presenting this particular topic is it's outside of our normal realm of the minimum financial requirements or the annual reporting requirements even. But over the last couple of years, we've recognised that there has been a lot of challenges that have faced the building industry. War in Ukraine, shortage of materials, shortage of trades. We started to see how that has impacted against small businesses in the building industry. And we thought that we would move into that space to highlight some of the challenges that we're seeing and also be able to provide you some guidance and some support in relation to how to minimise those challenges as well. So what we're going to run through today, it is a fairly dry topic. Hopefully you are comfortable and hopefully I'll keep you awake for the next couple of minutes. But it is very important to manage your business as well. So what I'm going to run through is the intent behind the financial requirements. I'm going to take you through some basic components of your financial statements. That's where it is a little bit dry, and then into those current ratios or financial ratios of a business. Then I'm going to step through the role of the building regulator within that financial compliance space. The key contributors that we've seen that can lead to financial difficulties and how to minimise those risks within the industry, and also some mechanisms that can help support or counsel your business along the way. So why do we have the financial requirements? Essentially, it's a law. Laws are implemented by the government, usually because someone's done the wrong thing. There is always an intent behind every law. We just have to work out what that intent is. So the financial requirements are no different to that. There's an intent behind that law. There's a really common misconception that QBCC's role is to prevent insolvencies. So we can't actually do that. It's a law that a director, if they're trading insolvent, they need to put their company into administration or liquidation. We also can't stop mismanagement of a company. So if someone wants to go out and buy 10 jet skis or a BMW or whatever the case may be, we can't actually stop them from doing that. What we can do through the financial requirements is to minimise the damage of any financial difficulty of a licensee. So we know about things a lot more sooner now through the annual reporting and through other intel, both internally and externally. We know that that licensee might be suffering from some financial difficulty. We can then try and minimise the damage within the industry to ensure that as less people are hurt as possible. So that's the intent behind the financial requirements. It's also, sorry, the financial requirements are also to ensure that people are paid through that supply chain and also to promote financially healthy businesses. So what are the financial requirements made up of? Essentially, they're made up of the current ratio, net tangible assets, and maximum revenue. So, and I'll run through those quite quickly in the next couple of minutes, but those last two, your net tangible assets and your maximum revenue, they're essentially married together. So your net tangible assets will set what your maximum revenue is and vice versa. So there's no point giving you a maximum revenue of $5 million if you've only got $5 in your back pocket. There's a bit of a risk there. So why do I have to give QBCC financial information? Essentially, it's a law, rightly or wrongly, whether you like it or not, or agree with it or not, it is a law. But more than that, it also enables you to have a quick touch point on your financial position at least once a year. So when the financial requirements were taken away back in 2014, the government and QBCC recognised that there was a whole lot of damage within that period of time. There was a lot of big collapses that happened. There was also a lot of small businesses that weren't looking at their books on a regular basis. So bringing back the financial requirements allows us to have a little bit more visibility over the building industry, but it also allows you to have financial viability or visibility over your position. As I said, at least once a year, you can identify those peaks and troughs within your business, and it also ensures that you are doing your financial reporting, so you have got books and records when you need to. So what is a current ratio? Essentially, it's your current assets less your current liabilities. Your current assets are anything that can be turned into liquid, anything that you can sell quite quickly. That could be an invoice to a homeowner. It could be work in progress that you haven't yet invoiced. It could be cash at within your bank account. What are your current liabilities? They are things that you need to pay, so your supply accounts, your credit card, anything like that that you need to pay in the next 12 months. A healthy business will have at least a current ratio of 1 to 1. So for every dollar of current assets they will have $1, sorry, every current, so I'll get that straight, every $1 of current liabilities, you need to have at least $1 of current assets to cover that. So if you think about your current ratio like a leaky cup or a seesaw that you need to keep a balance of, essentially you need enough water to go into that cup to absorb anything that's leaking out of that cup. So you don't want too much leaking out, otherwise if you don't have enough water going in, you're going to have a pretty empty cup at the end of the day. So that's essentially what your current ratio looks like. What are your net tangible assets? So your net assets are something that you might see on your balance sheet. It's essentially your bottom line. If you sold everything that you own and you paid out everything that you owe, it's what's left over at the bottom at the end of the day. The difference between net assets and net tangible assets. So a tangible thing is something that you can put a value on, and an intangible thing is something that you may have difficulty being able to value. Good example, cryptocurrency. We hopefully shouldn't see too much of that in the building industry, but something like goodwill is an intangible asset. It doesn't have a clear definitive value attached to it. It might be goodwill you might see in a franchise like GJ Gardner or Shroud Homes or something similar to that. That has a value attached to that, but you can't sell it quickly. Someone has to be prepared to pay you that value. So that's what we would consider to be an intangible asset. So net tangible assets are all of your net assets less anything that's intangible. I'll quickly run through the difference between annual reporting and MFR. Annual reporting, it is once a year. It's based solely off your internal management accounts for our mid-range builders or smaller builders or licensees. You don't need to have accounting standards applied to that. It can be literally off whatever internal system you've got, whether it's MyOb, QuickBooks, Xero, anything like that. It doesn't need to have your accountant prepare them. We would say go and see your accountant, not because of QBCC and not because of annual reporting, but just to make sure that you are running your business as well as it can do. And for annual reporting, you don't need an MFR report to be completed. So an MFR report is that higher standard. It does need to be completed by your accountant. There are accounting standards applied over it, but we only need them in really certain circumstances, quite limited. It's when you first apply for a license, you might need an MFR report. If you decrease your net tangible assets or increase your turnover by certain amounts, or if for some reason you end up on our naughty chair, we might request an MFR report for you. Other than that, it's just your annual reporting, that quick financial health check once a year. So annual reporting, it's based on your most recent financial year end date. Pretty much all of our licensees have the financial year end date of 30 June. It is just a quick financial health check, nothing more, nothing less. It does have those set due dates. I think they'll probably be set now, even if the government changes. They've been in place now for around about 5 years. I don't think they'll change those due dates. For categories 1 to 7, it's 31 December each year, and for SC1 and SC2s, it's for 31 March. So the reason for those dates being chosen, 31 December was picked for categories 1 to 7, mainly because it gives enough time for your 30 June information to be prepared and enough reliability for us to look at it and it be current enough for us to rely upon. There's no point giving us financial information that's 18 months old. A lot can happen in that time. 31 March was picked for SC1 and SC2s, mainly because smaller contractors go and get their BAS done at around about that time. Your annual reporting, pretty important to note that it won't change your maximum revenue that's set, and it won't change your last net tangible asset position. Only an MFR report will do that. So I'll quickly move into some of our more drier content for this afternoon. Bear with me and I'll run through this fairly quickly. Your financial statements are made up of 3 more important components. It's your profit and loss, your balance sheet, and your statement of cash flow. And I'll run through those just in a little bit of detail. So your profit and loss statement will draw upon all of your income that you've earned throughout that period, and it will take out any expenses that you've incurred to earn that income. What's left over is your net profit at the end of the day. And I'll quickly run through a real live example of one that's come across our desk over the last couple of months. You can see from the information that's on your screen, this company has gone in one financial year from turning over 1.9 million, and it's increased right up until 4.4 mil. So that's a fairly big increase over that 12-month period. What its profit and loss statement is also showing us, though, is to get that income from the 1.9 to the 4.4, it's had to advertise quite extensively, almost 300 grand worth of advertising fees there, or marketing fees. It's also got a whole lot more motor vehicle fees or expenses, so it's had to pay for more fuel, pay for more leasing or maybe servicing on those vehicles. The company's also engaged a whole lot more subcontractors to be able to do that work from 1.9 to 4.4. On the downside of that, though, the profit margin for that company has gone from a fairly healthy 44% down to a really concerning 4%. So that's quite a big jump over a 12-month period. That can be quite hard to try and claw back. I have presented this content throughout the state, and at the very first event that we held up in Toowoomba A young fencing contractor came up to me afterwards and said, I'm a fencing contractor in Toowoomba. What do you think my average profit margin should be? And I said, geez, that's actually a very difficult question to answer, because average profit margin should be around about 20% in the building industry, hopefully a little bit more. What I would definitely suggest though is fencing contractors in Toowoomba, gauge what your profit margin should be against other fencing contractors in Toowoomba. There's no point trying to compare a fencing contractor in Toowoomba, what their profit margin should be, as opposed to a fencing contractor on the Gold Coast. You're in completely different markets. You're in a different margin to Hutchies, publicly listed company. They run on a 1 to 2% profit margin, but they turn over billions of dollars worth of income, so they could probably absorb that profit margin. The young fencing contractor in Toowoomba, I don't think he would survive on a 1 to 2% profit margin. So this company that we're looking at the moment, that 4%, really low. On average, around about 20% is what you should be aiming for in the building industry. What your balance sheet should show you, or will show you, the difference between your current assets and your non-current assets. Your current assets are things that you can turn into cash quickly. So it's either your cash that you hold now, the invoices that you've got out for your homeowners or developers, and your work in progress that you haven't yet invoiced. And your non-current assets are things that you're holding long-term that aren't for sale. So your property, tools of trade, motor vehicles, plant and equipment, things like that, they're your non-current assets in your balance sheet. What your balance sheet will show on the flip side of that is your liabilities, and that's split between what you need to pay in the next 12 months, so your suppliers, subcontractors, your tax, your credit cards, things like that, and your non-current liabilities, things that are held over a longer period of time. A mortgage would be a non-current liability. And using that same scenario of that company that went from 1.9 to 4.4, this is what their balance sheet is showing for that same period of time. They've got a whole lot of work in progress, or more work in progress now, that they haven't yet invoiced to homeowners. They've got invoices out to homeowners that haven't yet paid them. They've bought a whole lot of motor vehicles, and they've bought a whole lot of plant and equipment. On the flip side of that though, they've incurred a tax debt because they're earning a whole lot more money than what they were in the previous 12 months. They've got a whole lot more creditors, so suppliers and subcontractors that they need to pay. They've got a bank overdraft now, which has probably been used to pay for that plant and equipment, and their motor vehicles are on lease. So that's a liability that they also need to allow for. What that shows is that a healthy company, it was sitting on almost $500,000 of working capital or net assets, that has bitten into them to end up in a negative position. So that negative 63,000 is what they're showing from that. So that would, that balance sheet would trigger a breach of the financial requirements for QBCC. It's showing that their current ratio is out of whack, so their current assets aren't enough to pay their current liabilities, and their bottom line, their working capital or their net asset base, is also quite low. It's in that negative figure. So what your statement of cash flow will show, it will show all the, essentially cash is king, and this is the first thing that your financiers or your lenders will pick up is your statement of cash flow. It's split into 3 distinct areas. It's your cash that is coming in and going out for your operating activities. It's the cash that's coming in and out for your investing activities, so whether you're buying or selling any plant and equipment or any big items like that. And it will also show the cash coming in and out for financing. So any loans or any bank borrowings will also be included in that. The most important part of your statement of cash flow is the cash that you started at for that period and the cash that you ended at for that period. And that's essentially what your bank or your lenders will pick up, how healthy that looks for that period. So what's some of those, some key ratios out of those financial components or from your financial statements? What your profit and loss will show you are your expenses rising. So that the company that went from the 1.9 to the 4.4 mil turnover, it has a lot of money tied up in those advertising, almost that 300,000. Is that something that they can now rely upon, word of mouth, rather than paying that expense? Are there areas that you can cost save on? Can you decrease some of your subcontractors? Have you lost or made money? And again, is your gross profit margin comparative with industry standards? But what I would say is compare apples and apples. Compare your fencing contractor in Toowoomba with other fencing contractors in that area. That's how you're going to come up with an industry standard that is good for your particular industry. What your balance sheet will show you is your profit, is your current ratio healthy? Do you have that one-to-one? Is your bottom line, your working capital, enough to keep going with the contracts that you have? Are you collecting money from your clients in a timely manner? I work for government, my salary is fairly safe, but what I would say to anyone is, if I don't get paid tomorrow, I'm not coming to work. Value what you do. If you're not being paid by your builder or your developer or your homeowner, make sure that you are aware of those mechanisms that you can use to get paid for that job. Don't wait for 6 months. Don't take on that next contract if you haven't been paid for the one that you've got in front of you. So make sure that you are collecting that money from people in a timely manner. Make sure that you are aware of those processes that you can use if you aren't being paid. Do you have too many external finance sources which have high interest? ATO, they're probably charging around about 11% on debts that are outstanding to the tax office. Banks are obviously a lot higher than that. I do have a current caseload. I do financial audits. I have seen one recently where someone did reach out to the ATO to try and get a payment plan put in place, probably a good step. The ATO came back and said, yes, we'll enter into a payment plan, but you need to pay the full amount to us next week. Just make sure that you do have mechanisms in place for those external finance sources. If you can extinguish them, make sure that they're the ones that you try and tip off first before other people. What your statement of cash flow will show, again, what cash is coming in, what cash you're spending. Do you have a negative cash flow? That company that went from the 1.9 to the 4.4 probably does have a negative cash flow. Not necessarily a bad thing. If you can address that with your financier and explain that you did take on a lot more contracts and that you do have mechanisms in place to increase your profit margin. Those sort of things, you could definitely explain to your lenders and to your financiers as to why you may have that negative cash flow. What the role of the building regulator is, and this is just within that financial compliance space. Difference between not lodging your annual reporting and not meeting the financial requirements, two completely different things. If you don't lodge by those due dates, it is something that QBCC does take fairly seriously. We do have actions that we need to take if you haven't lodged. It could be from a license condition getting imposed on your license. It could be disciplinary action. You may end up having your license suspended or even cancelled. So it is really important to lodge that information by the due date. If that information shows that you may not meet, that's a completely different story. So we are a risk-based regulator. We'll take action where there is a risk to the industry and we need to weigh up that risk first. Some of the things that we look at when we are identifying that risk and weighing up what action we will take or may not take, we'll look at the impact to homeowners, subcontractors, suppliers. Are you doing 1.9 million compared to 4.4 million? What the seriousness of that breach is that negative 62,000 enough for us to act upon, or is it a one-off where you've got something in place to minimise that? What submissions you've made or your accountant has made. We'll also look at what impact our action would take on you if we were to take action. So we would be aware that you would have employees that rely upon you, trade contractors that may rely upon you continuing to trade. Well, we need to weigh that up before we take any action on your licence. We will also look at other intel that we have available to us. We will look at whether or not you have monies owed complaints lodged against you, whether you've got defective work or incomplete work, whether your financial position is increasing or decreasing over a period of time. Have you had other breaches that you may not have rectified in the past? But more importantly, do you have a plan to come back into compliance? Can you turn that negative 62,000 around to a positive position, and how you are going to go about doing that within a reasonable period of time? So that's probably the most important one. Do you have a plan to come back into compliance? What does that plan look like, and over what period of time are you looking at doing that? So to recap all of that, we will obviously, or need to, not obviously, we will weigh up any discretionary factors that we need to before we consider any action or no action at all. So it's a discretionary piece as to whether or not we take action on a license. We need to be aware of all of the information before we come to a decision on that. What are some of the key contributors that may lead into financial difficulties? These are some of the things that we've seen over the last couple of years, not just from annual reporting, but from the market in general. The blurring of lines between business and personal spending. If you own a company and run a company, that is a completely separate legal entity to yourself personally. I have seen on balance sheets for a company an expense like child support. That's probably a personal expense, not a business expense. Again, some other contributors might be that you're not collecting that money on time from your clients or in a timely manner. Inadequate quoting or margins for those projects that you're taking on. That company that went from the 1.9 to the 4.4, do they have things in place to be able to manage that or identify that? If there's been delays on jobs because they've taken on too many, what are you doing to minimize that? Some of the other contributors, not meeting your statutory obligations, so not paying your tax on time or not even lodging on time, being unable to raise other sources of income, so not being able to have that facility from your bank to give you funds in an emergency. Biggest one in the building industry, and we've seen it forever and it continues to happen now, relying on that next job to pay for your last job. It only takes one hiccup in the road for that to come unstuck. So if you're waiting on that next job and the profit margin from that next job to pay for your suppliers or your subcontractors from that previous job, that's a really difficult position to be in. We really need to get some advice and some support to manage that journey and make sure that you come out that other side. A liquidators report that we saw very recently for a big entity. This essentially, a whole lot of words on your screen, but essentially it said this business went too fast, too quick, without having that that background or that base level of taking on those contracts within that period of time. So just making sure that you are aware of what your capital, your working capital is, making sure that you're not going too big too quick, that you can handle that $4.4 million contracts with the base level that you have. Some of the signs that some of those contributors have started to bite into your business, you might get to the limit of your overdraft or not get an overdraft at all from your bank. Some suppliers may start to take action upon you, and it's usually in the order that you'll see on your screen. They will say, we're not giving you any more supply. They'll then put your account on stop. They'll then put your account on cash only, and then payment up front. Again, relying on that next job to pay for your previous job. If you can't get material out of Bunnings to work on your current project, you're probably not likely to be able to invoice for that project, turn that invoice into cash, and then you're really digging that hole. That they are some of the indicators that you might see that businesses aren't working with you where they need to. What are some of the risks that your financial statements can show you or highlight to you? Looking at your financial statements, you should be able to see or identify some areas of improvement if you've got those expenses that you may be able to minimise on. Find out what the average cost of a standard job within your area is. Again, don't compare Toowoomba to the Gold Coast, completely different market. Make sure that you're aware of any changes in the market for pricing, for materials, for trades, things like that. It's really helpful to stay on top of that when it happens. Make sure that you are reviewing your financial statement on a regular basis. Make sure that you're reviewing things like your labour, your suppliers, your overheads, things like that. Are there any price increases that you need to factor into jobs? Again, are there any areas that have high interest rates that you could maybe reduce or hopefully eliminate if you are in a position to be able to do that? Make sure that your financial records are up to date and that you're looking at them. And if you aren't aware of the things that it will show you, make sure that you have someone in your back pocket that can help you with that. Evaluating the profitability, again, that $1.9 million company that went up to the 4.4, hopefully those profits are in those projects. I'm not sure if they went from the 44% down to the 4%. Are they running on time and are they running at budget? And if they're not, do you have mechanisms in place to identify that and then to alleviate that? Make sure that you are seeking professional advice. If you've got a bookkeeper or an accountant, make sure that they're on the same journey as you, that you do have a relationship with them, that you can pick up the phone, make sure that they are able to give you that advice, not just once a year, but hopefully in that timely manner. Hopefully that company that went from the 1.9 up to the 4.4, but profit margin went from the 44% down to the 4%. Hopefully they have had someone being able to say to that business, now you're sitting at 38%, now it's decreased to 25%, now we're sitting at 18%. Hopefully it didn't come as a shock when they looked at their balance sheets from those 2 financial years to go from 44% down to 4%. Hopefully they are aware or have been aware within that 12-month period. So make sure that you do have someone that you can rely upon to give you some advice along the way, and that they are on the same page with you to improve your business as you go. And then some people that can support you on your business journey. Make sure that you are tapping into your industry knowledge. There are great mechanisms in the building industry within your own trades as well as externally to that. Make sure that you are adapting to those market conditions. If prices are increasing, make sure that you're aware of that in a fairly timely manner and that you can on-go those or on-forward those costs. If you are starting to experience some financial difficulties or maybe just have a slight decline in your business, make sure that you are speaking to people. Make sure that you are speaking to QBCC, speaking to the ATO, get a plan in place if you need to, speak to your suppliers in a timely manner. Don't leave it until the last minute to reach out to them. They're probably less inclined to work with you if they're left to the last minute. If they know about it and they're on the same journey with you, they're probably a bit more inclined to work with you and give you that leniency. Also make sure reach out to your industry bodies. Pretty much in the industry now, there are industry support bodies for all trades. Wall and floor tilers have an association, electricians have master electricians, plumbers have master plumbers association, there is HIA, master builders. They have great tools on their website. You don't necessarily have to be a member to avail yourself of those. Those bodies also advocate though on your behalf. They advocate to QBCC, to the government about laws. So if you do have an issue with QBCC or within your industry, make sure that you do raise that with your industry body. They do support you and they will speak on your behalf. There are also a number of different places that are available and have free services that you can tap into. I know that Fair Trading have free budget tools available. They can help you with financial counselling. Also small business, the Small Business Commissioner, they also have free financial health checks that are available to you. QBCC has a website that you can search. that can point you in the direction of those particular government agencies. Sometimes the hardest part is knowing who to ask and what to ask for, but do a Google search. It can lead you in the right direction for free stuff, free financial health checks, free budgeting, free financial counselling services. A lot of them are available and are that you can use within your business. That is it for me. I will see if there are any questions available. I think there may be one here. Just one. Can a contractor take on contracts that are larger than their cash assets, meaning the contractor will be relying on progress payments? I'm going to, that's without knowing the context, I am going to say, if I can just read that again, can a contractor take on contracts that are larger than their cash assets? That would be extremely risky if you don't have the cash asset base to, and not necessarily because of QBCC's financial requirements, but more so, do you have the working capital moving forward to take on that contract? If you're looking at, say, a contract that is worth $5 million and your cash asset base is $500, that would be really risky. Do you have enough cash resources available in front of you to pay for Bunnings in advance, to pay for your subcontractors in advance? Because if your developer or homeowner or whoever's contracting you for that runs into problems and there's a dispute on the job, do you have enough cash available to be able to withstand that? So that's one part of that answer. The other part is the financial requirements. There is that maximum revenue threshold that you can't go over unless you've got assets that withstand that. I think that may be the only question that we have got for now. If we do have questions, I am happy to take them offline. So shoot them through. We will definitely take notice of them and happy to answer them. Or if you need any clarification on anything, again, it's quite a dry topic. So thank you for bearing with us. And I will hand back over to Sky. Thank you, everyone, and thank you for making time in your day.
Thanks, Natasha, for providing some valuable insights. Now, I wish to invite our second speaker, Louise Kuzovich from Desbit, to present some more information.
Thank you, Sky, much appreciated, and thanks, Natasha. It was very interesting to listen to that presentation for the first time. So thank you, everyone, for the opportunity to come here today and have a chat to you about particularly the Mentoring for Growth program. It's a Queensland government program. I am from Desbit though, but I am focusing on the Mentoring for Growth program today. It's a program that's been around since 2002, and we'd probably say hand on heart, it's probably one of the longest running Queensland government programs, and it's been successful because it is supported by wonderful volunteer business mentors. These mentors have helped over thousands of businesses since it started in 2002, and they provide businesses with tips and suggestions to overcome business challenges or opportunities they may be facing in relation to the growth or innovation of their business. As well as addressing growth aspects, mentors can provide tips on other business activities such as pitching for business, succession planning, exporting, dealing with business resilience. In addition to our standard offering of a business growth panel or a mentor chat, we also do provide some specific sessions. So if you're at a position where you're looking to export, or you're wanting to attract investment, or you're wanting to pitch your business to someone, we can actually get mentors who can help you with that business opportunity. So who is eligible? Excuse me. So we've got some high-level eligibility criteria for participating in the program, nothing that will surprise you. We'd like all participants to have an Australian business number, have a Queensland headquarters or significant presence in Queensland, a business plan in place. It doesn't have to be War and Peace, a plan on a page is sufficient. Have commenced business operations. Once again, you don't have to be established, you can be early stage, and we do have a lot of early stage businesses through the program. And we'd like you to come to the table with a specific business opportunity or challenge to discuss with your mentors. because that will make sure that you get the most out of your mentoring session. How does it work? So the program is available across Queensland, both online and face-to-face. The team use the information provided on your registration form to help identify the best available mentors for you to help you with your particular challenge or growth opportunity. The mentors are drawn from a Queensland-wide pool of more than 380 at the moment. They can help in a range of business challenges or issues, and they have a broad range of experience, knowledge and expertise to offer from various, not only operational aspects, but also from industry experience. It was interesting to note Natasha talking about a lot of the issues around cash flow management, financial tools and resources and challenges, understanding your profit and loss statement or your balance sheet. So we definitely can provide you with help in that regard if you'd like to speak to a mentor. If you don't understand some of the terminology, or you're looking for help in how I price my product, how I do a competitive analysis, we can definitely help you through that through one of our mentoring sessions. Who are our lovely mentors? So as I mentioned just previously, we've got 380 odd currently across the state. We do have I will admit, quite a concentration in southeast Queensland, but we do, through the virtual delivery of the program, we're able to connect you with mentors from no matter where they are in the state. So they have specific business skills and qualifications and experience working with certain industry sectors. But one thing they all do have in common is they have experience in mentoring and coaching. And we're also conscious that the business world is continually changing. So to reflect that, we do take on mentors twice a year through an onboarding process. We want to make sure that we are keeping up to date with contemporary business issues such as AI at the moment, cyber security, continual resilience planning that has to come up, that we're not aware of some other issues that may not be on the radar at the moment. So we are responsive to that by doing 2 intakes per year for our mentors. So some high-level benefits for the business, and these have been captured from both mentees and mentors who've been through the program. So some of the things they tell us is that participating in a program provides a sounding board to help small business owners make decisions with more confidence. They can test their ideas with a couple of mentors. It helps them develop and grow the business through improved planning, performance and productivity. It broadens their business networks through ongoing access to mentors and other references provided by mentors during their session. It helps identify new opportunities to improve ways of doing business or different innovative solutions to business issues and challenges. And most importantly, it identifies areas and blind spots that businesses may not have seen themselves. So those extra 2 or 3 pairs of eyes from the mentors coming to the room, having seen and heard about your business for the first time, will often bring that a different perspective to what you think your business challenge or opportunity may actually be. One question we often get asked about our mentees participating in the program is the information that I disclose in my registration form or in my mentoring session confidential? And yes, we want to definitely say absolutely it is. As part of being onboarded to join the Mentoring for Growth program, and mentors have to sign a deed poll. And that deed poll includes clauses around the confidentiality of information shared in your registration form and also what's discussed in your mentoring session. Our mentors also have to adhere to a code of conduct. But it's also important to note that when participating in a session, the mentors are drawing on their knowledge and experience to help you. Their comments are suggestions and tips, they're not advice. They may suggest names of persons or organisations that can further assist you, but they cannot specifically recommend these details. So prior to your session, we make sure that we share details of your mentors who are participating. This gives you an opportunity for you to review them. You can check their details online that they provide. If you think there's an actual or perceived conflict of interest, you can notify us and we can definitely organise alternative mentors for you. Likewise, our mentors may also opt out of a session because they perceive it to be a conflict of interest. So they may be in the same industry sector that you are in. So they just say, well, it's not really appropriate. So that's fine as well. Of course, I could tell you how wonderful the program is, but there's nothing better than hearing from an actual participant themselves. So I just wanted to share a lovely testimonial we received from a company based on the Gold Coast, Squeedex, who practice squeeding practices. Surprise. Owners Colin and Carey have been through the M4G program 5 times since they started up their venture in 2021. And they provided the following feedback, which I think is worth reading out to you. So at the heart of Squeedex lies a commitment to innovation. So when we discovered the M4G program, the mentoring sessions felt like a great opportunity for us. They not only introduced us to a refreshing perspective, but also connected us with mentors whose wisdom and expertise was deeply rooted in the building and construction industry. The beauty of these sessions lies in the experience of being able to engage with a panel of mentors. Their collective knowledge, honed through years of industry involvement, has given us clarity and the strategic foresight needed to continue to build our business. That's lovely feedback from Kirsty and Colin from the company, and I'm pleased to say they've actually registered to come in for another session. So they do take up the opportunity to come in every 6 months. So the next step, so if you're interested in having a mentoring session, it's quite a simple process. We have an online form which you can access via the Business Queensland website, or you can contact us at that email address, m4g@desbit.qld.gov.au. This website address and the email will be shared with you as part of a wrap-up of today's webinar. The registration form takes approximately 15 to 20 minutes to complete. You'll be asked to provide answers to some high-level financial questions, such as your yearly turnover, gross profit, net turnover for the last 2 to 3 financial years, as well as listing your top 3 questions about your current business opportunities and/or challenges that you would like the mentors to focus on in your session. Once our team receives your registration form, we'll be in contact within 1 or 2 days to book you in for your mentoring session. We hold sessions weekly, predominantly Tuesdays, Wednesdays and Thursdays, and online, but we also are very keen to work with stakeholders and provide face-to-face sessions in regions where and when we can. We just came out of Queensland Small Business Month, and we did quite a bit of mentoring sessions on the ground across Queensland to support those Small Business Month events. Our free mentoring sessions are quite popular, so they book out about 2 or 3 weeks in advance. We like to give our volunteer mentors a minimum of 2 weeks to review the information that you provided in your mentoring brief, so they can do a bit of homework as well and be prepared for your mentoring session. That will ensure that you actually get the most out of the 45 minutes or 90 minutes that we actually provide time for you in your session. At the end of your session, the team who will be facilitating will provide some session notes for you. These session notes will include a summary of what was discussed in your mentoring session, and also maybe some tools or references that you can further investigate to help. So that's firstly covers off the Mentoring for Growth program, but I'd just like to quickly mention a couple of other services that the department offers. In line with the Mentoring for Growth, we've actually recently done a series of what we call the Ask a Mentor article series sessions. They are webinars as well, where we actually had 4 or 5 mentors participate on a topical issue. We've had one on cash flow, we've had one on business planning, marketing strategies, AI chatbots, I think a series of 12 we've done now, and they are available via the Business Queensland website, which I mentioned earlier. Of course, I'd like to say Natasha did allude to this in her wrap-up, that Business Queensland is one of the great resources for you to go to access a plethora of tools and resources available for businesses at various stages of the business operations, from early startup to growth to expanding. You can, via that website, you can actually register to be subscribed to the Business Queensland Connect newsletter. great resource that comes out monthly and actually provides information on new grant programs you may be eligible for, new other assistance programs that may be offered across the state. At the moment, we've got one in market, so I would really highly recommend that you actually do sign up to that newsletter to keep abreast of those services. And finally, as Sky mentioned in their overview, the department not only delivers the Mentoring for Growth program, which I've focused on today, it's also responsible for the delivery of a number of employment programs and services, including support for job seekers and employers, and training in skills and initiatives such as apprenticeships and traineeships. So thank you so much for giving me the opportunity to talk to you today about the Mentoring for Growth program. I'm very happy to take any questions. Throughout of the webinar, which I'll just touch on, is we've been asked a couple of sessions, do I have to be there, or who has to be at the actual mentoring session? And I'd just like to probably give you an idea that because we're talking about decision-making issues, it's probably best that we do have a business owner or a business decision maker participating in those sessions. You could have yourself and your partner, yourself and your marketing person, for example, depending on how you set up your business. So yeah, you could definitely have more than just you. You could have a partner also attend, but ideally we want a person who's responsible for making business decisions participating in the session. Okay, well, I don't think we've had any other questions come through as yet, but please feel free to pop one in the line or even contact us afterwards. Very happy to get back to you, even if it's from another area of our agency. So thank you so much.
Thanks very much, Louise, for your presentation. Before we wind down this webinar session, I'd like to remind everyone that you'll be receiving a survey about this evening's event. So if you could please provide your feedback there, that would be fantastic. If you do have any questions that you've just thought of or you've just sent through in the chat box and we didn't get a chance to answer them, make certain you include them in the survey as well. Once again, thank you for your attendance and good evening.